You're watching Stock Watch. I'm Zwelakhe Mnguni, and joining me to unpack your stock-related questions today are Zwelakhe Mnguni from Benguela Global Fund Managers and Sanelisiswe Tofile from All Weather Capital. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X @BusinessDayTV using the hashtag StockWatch. Thank you so much for your time, gents. I'm actually wondering about the kind of volatility we've seen over the last 2 days. Of course, yesterday, while we were resting, the Trump was not resting and the US markets were not resting. They took quite the knock yesterday after Donald Trump's continued attacks on Fed Chair Jerome Powell. Sanelisiswe, just talk to me about that, but also the incredible rally that we're seeing, especially in the US markets today.
Yeah, so I mean, the volatility you've seen is unprecedented.
Yeah.
Obviously, the risk now, the additional risk to what tariffs announced in the past couple of weeks is now the attack on the Fed puts into question the independence of the U.S. Federal Reserve, and that has implications for the currency. We are already in an environment where inflation is still lingering. Obviously, it's been coming down for the past few years since the COVID highs, but it's still lingering, and you need very focused and targeted kind of monetary policy. And if you've got political interference, that does pose a problem. And that independence will obviously cause a bit of loss of faith in the dollar, and you've seen the dollar weaken already given these tariffs. And any further weakness in the dollar probably puts into question its status as the reserve currency, especially if you add the fact that the US has basically gone to war, economic war with other countries. So it just adds to the volatility. And I mean, I think any rallies that you see now are just a function of, in my view, investors not really knowing which direction to go. One day it's up, one day it's down. So it's just a lot of volatility to contend with.
Yeah. I'm going to ask a question that I asked someone earlier on, Zwelakhe. Has Trump not heeded the warning of rattling the markets too much?
I don't think he cares about markets, that guy. Or he does, but only if it suits him. I think he's basically trying to kitchen sink the economy so that he can get a good low base, and he can maybe perform better towards the end of this term. I mean, it's not a pleasant situation to be in as a market participant, because there's a lot of uncertainty, and some of these actions are going to take probably 6 to 12 months to unwind. This tariff war with China is not something that's going to be changed overnight. And some of the supply chain changes will actually move probably forever. That guys are trying to diversify away from China, as they can see that he's got his crosshairs on China. So it is not a pleasant environment, and hence we've seen the dollar weaken, as Sanelisiswe said.
Yeah. Well, before we get to the questions, I actually want to talk about Aspen, because they released quite an announcement on at 5 p.m. at market close today. A lot of people, I'm sure, didn't see it, but of course, it was on risks that could affect their manufacturing performance, saying that there's a contractual dispute. And looking at those numbers, I mean, not everything is clear at this point. They spoke about core profit for the manufacturing division being 2 billion rand lower than had previously been guided. If indeed, I guess there is a breaking up of this contract. Sanelisiswe, I do know that there's a call tomorrow morning that they are presenting. What are you thinking? Because at this point, I'm just thinking when the markets wake up tomorrow, there could be a lot of nervousness.
Yeah, I think you're right, Zwelakhe, because, I mean, what this announcement essentially announced is a profit warning. Earnings are going to be significantly lower on the back of this. I think one of the challenges with Aspen is that we tend to want to view it as a pharmaceutical company, when in actual fact, the substance of the business is a manufacturing company that happens to manufacture pharmaceutical products, either on behalf of someone or operating facilities that manufacture off-patent products or whatever the case may be. So I think the real risk here lies in the fact that you have to think about what the business, actually does and how it kind of operates. And the reality is that Aspen is maybe a mix of a manufacturing and a pharmaceutical, maybe more manufacturing than a pharmaceutical company. So you have to overlay those kind of risks. The one thing that analysts have always talked about with regards to Aspen is having all these facilities, where they operate from, and being able to fill capacity and kind of move the product that they produce out of those facilities, which is a terminology that you essentially see from like an industrial or manufacturing type of company. And the trouble is that they've from time to time had trouble filling the capacity, which obviously has impacts on operating rates and margins. And this has always been a lingering question about what the next leg of growth for Aspen will be, how they're going to perform, what the next product is going to be. And I think this dispute that they're now raising here also speak to the potentially the nature of the balance of power between them and their customers. Maybe they are a bit on the back foot here. So I think this is quite a negative outcome. I'm reasonably confident this share will be quite significantly lower yesterday. We'll have to see what they say on the call, but this is not good at all.
And that's the thing. I mean, you talk about the growth that investors had been attaching to Aspen, and because of these contractual agreements and partnerships that they have gathered over the years, seeming that this is putting a spanner in the works because it is quite material. And on top of that, it's not even that, because they also did mention risks coming out of the tariff chaos as well. Zwelakhe, are just things not looking good at this point for Aspen?
I would probably take a stand, move back a little and say, I think for me, this is a governance issue. I think Aspen has gone too far in complicating its business model. Multiple jurisdictions, multiple business models. I mean, as Sanelisiswe talks about the pharmaceutical side, then you have the contract manufacturing, and you have to deal with so many moving parts in this business. And I just think that management has been talking up the manufacturing business for the last probably 2 reporting cycles, that they're getting contracts, things are moving up. And to wake up and just have this sudden statement about a dispute that is about 50% of the revenue for manufacturing. I haven't read the statement and internalized it, but to me, this is just a governance issue. It's a question of what is the board doing about this. I mean, there has to be consequences. I cannot think of anything else. This business has come from the brink. Probably this would be the 3rd time if this dispute goes against them, and they too focus on growth, way too focused on growth, less about returns, less about stability. I mean, they had turned the business around. They went into, again, an aggressive expansion mode. So, yeah.
Okay.
I think the share price would be hammered tomorrow, irrespective of what they say, because this is just rattling the trust or the faith that investors have in the stock and management.
Yeah, it's quite interesting what you're saying, that they've been talking up the manufacturing capability and growth, and really investors have been saying that for optimism to come from them, that they actually need to implement the plans that they have for the manufacturing division. So it's going to be quite interesting. I'm hoping to talk to Stephen Sard tomorrow, so hopefully I will get a chance to ask him all these questions that you guys have. All right, let's get on to the questions that have come through. This is an interesting one. As much as we hear about stock picks, can we start hearing stocks you guys are lightning on, you guys are offloading? Sanelisiswe, anything to say about that?
I mean, it's hard to say that you're doing any significant lightening in this environment. I mean, I think if you are looking at anything in your screens right now, you're actually looking for opportunities to buy, given where things have fallen. If you are, in my view, if you are lightening anything in your portfolio right now, you're probably panicking. I mean, you might see a lot of panic in Aspen tomorrow, which is, I guess, natural.
Yeah.
But it's hard to say that there's anything necessary that you are reducing or that we are reducing.
Okay.
Many things, let me say, not everything, many things are looking like buying opportunities rather than selling opportunities at the moment.
Interesting. So Sanelisiswe is looking at the current environment as ripe for buying, not necessarily lightening the portfolio. Zwelakhe, on your side?
Yeah, look, I agree with him not to react in panic, but there are also trends that are shaping up to be slightly longer dated. And I think if I just look, for example, in the US, the consumer discretionary sector is going to take a hit. Yes, the valuations are starting to look interesting, but there are still some inflated valuations in that market. And you also look at some of these tech stocks that are going to have a struggle to battle the tariffs somehow. I mean, the main thing is that if China was softening up, I would say, don't look at anything. I'm saying you have to try and look for opportunities where you can upgrade the quality of your portfolio. While you are conscious that you shouldn't be bailing out. If something is already down 40%, I mean, it's too late to react. But I would also say that you need to be nimble in your approach and look for areas where there could be more pain, and the structure of the supply chain for the importers in the US is probably going to change probably for the long term. So, because companies have to now diversify their production away from China, and China has to find ways of supplying the same product into the same markets, whether through backdoors or third-party countries. But then that's going to be deflationary because they'll dump their product in those markets. These companies have diversified their production to other areas. So there has to be a bit of caution that I wouldn't do anything. I definitely I am looking at consumer discretionary. Our team is hard at work looking at that to say what could go wrong, which parts of that value chain could be safe, and let us maybe upweight those because the market has reacted randomly or broadly. But certainly, I wouldn't just sit and do nothing.
All right. Let's take a look at BHP and Anglo American. Your take post the failed takeover, Zwelakhe. And then the second part of that question is tariff risks, I guess, on both of these counters. So let's start off with post the failed takeover, I guess your take on the individual miners.
Yeah, I think if I just look at Anglo's probably has got a bit of a self-help story, but I think once they get rid of Amplats, I mean their portfolio would probably be dominated by iron ore, just like BHP is, and that leads us to a point about the China tariffs and whether China will be demanding a lot of iron ore when their steel is being blocked in some markets in a way. So, for example, in the US, I saw India put up about 12% tariff on the Chinese steel. So we may see other countries taking a defensive mode to defend against the dumping of steel products from China. as a result, the iron ore market may be under quite a lot of pressure. So post M plus, I'd probably say that the two stocks would probably look similar, but I think it may still be possible that a deal could be done by one of the majors to try and take over Anglo, particularly for their copper assets.
All right. Very interesting take there. Sanelisiswe, your take on both those counters and any nervousness that you have on the tariff risks?
Yeah, I think I don't have anything significant to add to Zwelakhe's point here. I think obviously the copper asset is going to be the main thing going forward. I think that's really what BHP were looking for. I mean, I think copper is probably about 30 or 40% of the kind of the mix for Anglo-American, and that's really what BHP were looking for. And obviously, once Amplats is listed off, then the copper asset will be sort of, I guess, the main thing left there together with the iron ore. So I think Anglo is in a good position to benefit from this new demand of these, the new age metals for clean energy and the likes. So there could be a deal, but they are on their own kind of value unlock strategy. So self-help is probably one of the things that they've got, and there's probably still some value there. There are risks on a macro level, given that iron ore is a GDP type of metal, but I think still some benefits there.
Okay, all right. Interesting take there on that copper exposure as well. Well, let's go to another diversified miner, Glencore. Glencore and its directors have been buying back its shares. Is Glencore offering value at current levels? A lot of people have actually been asking about Glencore lately. Zwelakhe?
Yeah, I'd probably say it is. I mean, but you have to think long term about it. I mean, it's got a good portfolio of metals, some of which are exposed to the electrification wave. So I do think that at current levels, it does look interesting. Of course, I mean, when the global growth slows down, a lot of capex budgets, a lot of consumption expenditure would be revisited. But I think on a portfolio basis, it will probably look a lot better than probably Anglo's and BHP in my view.
Glencore, because I think it has actually underperformed the sector recently. Sanelisiswe?
Yeah, that's exactly right. It's underperformed the peers, and I think management buying back shares is a sign that they obviously see value in the share at current levels, and that's sometimes an indicator of a good time to buy. So, I mean, I'm not terribly close to it, but looking at where it's performed and looking at the fact that management are buying, it can give you a clue as to some value being in there.
All right. Well, talking about buying, let's go to the S&P 500. It's had bad days since the beginning of the year. Is it a good time to buy into the S&P 500 at this point in time, Zwelakhe?
Look, it's always a good time to buy equities for the long term. But if you are short-term investor, I'd probably say be cautious. Make sure that you don't overexpose yourself to that specific asset class or market. But if I think long term, I mean, I think the US is ahead on multiple fronts in terms of the technology wave, which has become slightly frothy in the last year or so. But it will normalize either through earnings coming through or valuations pulling back. And that will pull back the S&P 500 because it is a significant component of that. But beyond that point, you've got some good companies in the S&P 500, and you can do well over the long term. So outside of the short term, I'd say I'd buy it.
Well, Sanelisiswe, you were talking about finding buying opportunities in this market. Would your eye be on the S&P 500?
I think that I'm going to take the more cautious approach here and say that it's probably a bit too risky at this stage. I mean, we've already said that, the valuations are quite a bit high. And if you factor in the recession risk being posed by these tariffs and the fact that any further escalation in the US-China tariff war could bring potentially Taiwan back into play in terms of an invasion from China. And that could see a scenario where they kind of cut off any chip supply to the rest of the world, particularly the US, and that's going to be very bad for tech companies generally. And if you've got companies like Apple trading at 40 and 50 times multiples, and all these other Mag 7 companies also depending on these tips. I mean, I think Apple and Nvidia alone could be wiped out from that kind of scenario. I'm not kind of raising any alarms on any kind of doomsday scenario. I'm just making the point that there's still a lot of risk in the market at this point. So I don't know if it's necessarily the right time to buy, even though the index levels are settling down. There could be some further downside in my view.
Okay, well, let's look internally as you're talking about a potential U.S. recession. The last question before we get to your stock picks, SA counters to hold on to in the event of a U.S. recession. Zwelakhe.
I'd probably still hold on to banks. I'd hold on to staples. So amongst the banks, I'd probably still go for Capitec. I think they may be exposed to the lower end of the lending market, so the personal loans market unsecured. But I do think that it might still be able to do better, primarily because they've got systems that monitor their customers at the employer level. So they don't monitor just the employees, they monitor at the employer level. I also think the likes of Standard Bank, First Rand, they would do well. I mean, South African banks are looking quite decent. Of course, you're going to have a slowdown in the economy and you'll have a little spike maybe in the bad debts, but it's not something that I think would be persistent in the long term. I think we'll normalize again over time. So I'd also take some of the staples. I mean, the AVIs. I'd also take Bidcorp, Bidvest, those type of businesses. Yeah.
All right. Sanelisiswe, just quickly, where you'd be looking in case a U.S. recession does materialize?
I don't think I can name anymore because Zwelakhe's named all of them here in his comment. But the main thing I would say, look, quality, always gravitate to that. Anything with strong and sort of stable cash flows, anything with a well-supported balance sheet in that environment will do well. And I think a lot of the names Zwelakhe's mentioned are fit that category. So you always gravitate to quality in that scenario.
Okay. In terms of gravitating towards stocks and good quality companies, what are your stock picks for today, Zwelakhe?
I'm going with the Agnico Eagle Mines. It's a gold miner based in predominantly Canada and US. There are two reasons why I think it is probably an attractive option at this time. I think the vulnerability of the US dollar against what we are seeing in the US, potentially if Jerome Powell is fired, I mean, we will probably see gold price climbing even further. And then in terms of the cost of production, they are around the 1,300 all-in sustaining cost. So I'll probably think that they would be a safer play against a backdrop of mines being confiscated in the northern part of Africa. But Goldfields has just reported on some of that. But you do need gold, and I would take that safe gold in this manner.
All right. Where are you finding value today, Sanelisiswe?
So I'm also going for a miner, but a local one in Sibanye. I think there's a few positive things going for Sibanye. Obviously, relatively constructive on the PGM sector, given the kind of trailing performance in the past couple of years. And also remember, Sibanye has also got gold exposure, which was a smaller business in the past couple of years, but now with gold at almost 3,500 rand, it's becoming a meaningful contributor. They've done a few cash flow deals, streaming deals, so core streaming deals to kind of help bring cash flow forward to help shore up the balance sheet as well. So I think those concerns are being allayed from investors. So it's a good option, I think, at this point to look at some money.
All right. Well, thank you so much for your time and for your analysis today, gents. Really appreciate it. That is all for Stock Watch tonight. Thanks to our guests, Zwelakhe Mnguni from Benguela Global Fund Managers and Sanelisiswe Tofile from All Weather Capital. Up next, The Close. Stay watching.